Hey everybody, David Steinley here. Thanks for joining me. This is Cashflow modeling for startups. So I've been working as a fractional CFO for about 6 years now, and been doing modeling even longer than that. And I've created probably near 100 cash flow models by this point. And it just really has given me a ton of perspective on different types of companies and different industries. It's given me the ability to diagnose challenges before they come up in the fundraising process. And yeah, I really think founders would do well to learn this stuff earlier on so that they, can make better decisions along the way. I thought of the analogy the other day. It's kind of like when you go on that pilgrimage up the side of the mountain to that monk's temple to ask a question, right? Because you're grappling with something. The financial model is kind of like that monk sitting up there, right? Like you're the one who came up with the idea. You're the one who needs assistance, but you just want to double check it with someone, right? To make sure that this is actually reasonable. So it's a lot about peace of mind, understanding your runway and how far you can go under different scenarios, right? And we'll talk a lot about that. Finance always follows what's happening in reality, right? So it's reality on this side, finance on this side. Finance mirrors it, right? And the more accurate that mirror is, the more you can see what the actual impact of all of these realities and strategies that you're thinking of are on your finances. Okay, so it never hurts to be able to build that skill set of thinking in terms of, well, if we pursue this, what does that do to our runway? If we pursue this and we're able to earn these margins, how much more runway does that get me? And I'll be talking about runway a lot because this is a cash flow model. And what it's doing is we're going to spend a lot of time calculating a whole bunch of different categories of costs or cash in and cash out. And then the ultimate output of this whole model is going to be what your cash balance is at the end of every month for the next 5 years. Okay. Yeah, obviously stronger plausibility at the beginning and then weaker as it goes on. So let's get into this. We're gonna jump in. I'm gonna build this in real time. Yeah. So I think first off, it probably makes most sense for me to show you what a complete model looks like, and then we'll get into building it from the ground up. So number one thing here, this is the title page for this. So I created a mock data room for a fictitious company. So the data room is complete. The company is completely fake. But I created all of the files in the data room for it. A completed data room would be ready to ship to investors. I'm not sure if this would be an investable opportunity, but it would have a chance. Probably the market would be the biggest issue. It's an oyster farm monitoring technology that they have. So hardware, software. And that's what this model that we're doing today is going to be based on. So you'll see more about this as we go on. So this, what we're looking at here is actually one of the files in that data room that I've created. So it's already good to go, basically. Now I'm going to have this beside me so I can refer to it as we go, so I can hopefully get through this in a reasonable amount of time. In case you're curious, it usually takes me about 6 hours once I sit down with Excel to do this. Then there's probably another 14 hours in a project on either side, just collecting inputs and having conversations. But yeah, to actually do the modeling takes about 6 hours to get it front to back. Yeah. So this here is a bit of a schematic. And what it's saying is that there's basically three different sections. So on the far left, we have the dashboard, which consists of the profit and loss on an annual basis, some metrics and some charts. Okay. There's also a key assumptions tab, and you can see how these track down here, right? So key assumptions and dashboard. On the left, it's the most summarized information. Then we go to the right, and things start to be, decomposed, right, into their constituents. So the cash flow model or summary is next up, and that consists of what is effectively a cash flow statement, if you remember your accounting from way back. So you start with sales, you take away your cost of goods sold, and then you get your gross margins. And so we'll talk lots about that, probably the most important thing here. Then you have your operating expenses, which are very much like your budget. And then you get operating income from, or cash flows from operations is another way to put it. Then there's two other things. Anything you do regarding capital spending, okay, so investing in longer term assets, durable assets that are effectively investments. And then there's going to be financing, and that could be a cash inflow or a cash outflow. To be fair, both of those can. And the combination of operating income, capital expenses, financing, that's what's going to get us to the cash balance when this is all over. And then so that's kind of the roll up here where everything comes together before it's communicated. But when we go even deeper into this, we get to these other tabs: sales, cost of sales, operating expenses. And these are the trickiest, the most time consuming things to come up with in the first place. In particular, I should have changed that to sales, but you get it. The sales subschedule is, I would say, possibly a third of the work that goes into the model. And there's a lot of reasons for this. Mostly it's just you got to figure out what's in scope and what's not, and then you got to figure out the logic that actually drives the calculations in the model. So we'll get into talking about this a bit, but I'm going to need to glaze over it or not spend too much time, or else we're going to be here for many, many hours. Okay, so I'm going to show you first, zoom out a little bit. Here's the dashboard. So we have the 5-year financial statement, same flow of information that we just talked about, ending with cash flow from operations, which would kind of be like net income in this case. And then a calculation of cash balance over the years. And then there's some other things like metrics on, I count up the amount of customers that are implied from the model. I count up the number of employees that would be implied in the modeling and compare them to, what we might expect revenue to be based on the amount of employees, used as a proxy. So it's a bit of a gut check to see if there's enough employees built into the model, meaning enough cost. And then there's this use of funds calculation, which I actually don't use anymore. A couple charts over here. Okay, so sales over time, how these sales relate to the market that is also in the data room here. So we're saying effectively 11% penetration by year 5. Lots of other charts here. So we're actually not going to spend too much time on the dashboard because it's more important we know how we get there in the first place. This is the first tab where now this is actually the same information as the dashboard here, but now you can see that we're going monthly, right? Cash flow from operating activities, from investing, from financing, and then finally ending cash. So that's that. And then we get into each of the subschedules. So summary data at the top, all the calculations that are based on sales drivers at the bottom. Cost of goods sold, same thing, summary at the top, a couple metrics, and then getting into how those costs were created in the first place. Operating expenses, you guessed it, all the operating expense categories are rolled up together at the top. That's research and development, sales and marketing, general and administrative, and then all of the calculations down below, along with a employee headcount counter up at the top. So that's the way it's going to look. And then quite a few rows on the OPEX side of things, operating expense, that is 129. And then it goes over for 1, 2, 3, 4, 5 years. Okay. So one of the first things you might notice about this is that each one of these tabs is actually formatted the exact same way. So if I was to scroll over, this is going to go for 5 years. And the reason we want this all set up the same way is because I bring these headers along as I go through, and it really helps me speed up the process of, I don't just use the template, I recreate them every single time because it ends up being quicker given the nuance of each individual model. So it helps to standardize the approach. I'm going to get rid of that. Yeah, so that's what it looks like when it's done. But the crazy thing is that it looks like there's a lot of complexity here, but there's really not that much. The calculations are very simple. It's adding, subtracting, multiplying, dividing. There's a few more complex formulas when it comes to pulling in the right customer count at the end of the year. The sum if formula. We're probably not going to talk much about those because, like I say, it's like it doesn't need to be anything more than referencing cells, adding, subtracting, multiplying, dividing. And ultimately, this is all on a cash basis. So what we're trying to do is assess when cash is coming into the company and when it's going out. And the net impact is going to be what you need to know for all of the fundraising rounds that you're doing, and of course, managing your business and making decisions. Okay. So let's figure out how this becomes so big in that case. So maybe a couple quick calculations here. So like I say, it's cash in, and then cash out, cash balance. So if I had 10,000 in, let's call it 5,000 out, Oh no. Can't use my alt formulas because this is a Mac and I'm not used to a Mac and I'm used to a PC, so bear with me. That's going to be tricky. Okay. So cash balance at the end of all this would be $5,000. Cool. But, obviously insufficient. So what's this cash in? Well, first off, we're going to have, let me do a little bit of formatting here. So cash in, let's call this cash summary. Cash in is going to consist of sales less your goods sold equals your gross margins. Okay, and then cash out is going to be R&D, sales and marketing, general and administrative. Are you going to add back recoveries? And then cash out. Let's call it total. I'm going to use shorthand here. Operating expenses is OPEX. Okay, so it looks something like this. You'd have maybe 20,000 in sales, less 10,000 in cost of goods sold, and that leaves you with $10,000 in gross margins. You've probably heard a lot about gross margins. But effectively, gross margin is what you make on each individual sale that's now available to pay for the rest of the costs that your business incurs, right? So your gross margins are then allocated to your business overhead to pay that off, and anything that's left over is going to be profit. That's going to be either reinvested or distributed to the shareholders. So let's call this, we don't actually want to do that. We want to do this, divided by that is 50% gross margin. What's good in gross margin? It strongly depends on what industry you're in. So, I mean, software can be like 90% gross margins, plus or minus 10%, right? Like incredibly strong, especially when they're in a niche, right? As the company gets bigger, they get a little bit more, come back to reality, but software is very, very high. Reason to get high valuations too, right? They print cash in some cases. Whereas if you're, say, Costco, good example, of low gross margins. They're not going to make much on individual sales, but because they're a volume game, they're going to make a lot of money in the end. So actually Costco's net margins are something to the tune of 1 or 2% of their sales. And so very, very slim in a percentage basis, but in an absolute dollar basis, they're still printing money. Okay. So gross margin 50% here, that's just random number I thought up in my head. Now let's say R&D, it's it'd be more like $4,000. Then sales and marketing might be the same. General and administrative, maybe that's a little less, right? And then you did this recovery, so you got some payroll grants for some of your R&D, so maybe that was $3,000. Okay. Now we're going to put that there. So maybe your overhead, net overhead, after that grant was $7,000. Then here's the thing. So you get to your cash balance. So opening cash is the first thing we need to know. Change in cash, and then ending cash. Okay, so opening cash, maybe there was $5,000 in the bank. Just lost 7,000. I'm doing this in real time here, so we'll see what this looks like. And then gonna go up there. So we're gonna end up with negative 2,000 in the bank, which is not possible because you can't really go negative unless you got some serious overdraft, which is probably not good to get into so early on. So the question becomes, well, look, if we're gonna be in the negative, what can we do, right? And that's where we're gonna get into, of course, some financing, right? This is where it all comes back to. So cash in, cash out, then we're going to get to I'm just going to add a few columns here because this isn't complete yet. So we get our cash flow from operations, and then we'll need to add a few more rows here. Let's go cash flow from investing. So that'd be capital assets. I'm just going to leave it as is, and then cash flow from financing. Let's call it non-dilutive and dilutive. And total. Okay, so gotta put a little. Hey, we're gonna put one of these in there. We're gonna put one of these in there. So sum, and a couple of the keystrokes I'm using in case you care. Equals a sum and then a bracket open. I'm just going to mouse up to those two, put a comma in between them. I'm going to get my cash flow from operations, cash flow from investing. Nah, we didn't buy any capital assets right now. From financing, so non-dilutive financing. This recovery here, if that was a payroll grant, could also be included here. Doesn't matter too much, but I like to think of the non-dilutive as the bigger grants. So say there was a grant that we got for 10,000, that's nice. And then the non-dilutive, that would be like a seed round, pre-seed round, whatever, from private capital sources. But let's say we didn't do that this time because we got this non-dilutive grant and we don't need to. And we're not going to dilute the company if it's not necessary, of course. So in fact, the change in cash should be the sum of operations, investing, and financing, okay? So what we come to at the end of the day here is we started with 5,000 cash. With the net change in the month was 13. So we actually end up with more. Okay, so this is like pretty much what we're looking at when I go back, like say here, right? The same flow of information. It's all the same. This here, sales, cost of sales, gross margin, OPEX, cash flow before taxes. You know, I'm probably gonna ignore those for today. And then we got investing activities, financing, and then cash summary at the end. So I'm just trying to demystify the challenge that I think a lot of people face in getting into a financial model in the first place. And keep in mind, there's no accruals here, right? So I'm not thinking like, well, you know, what's our accounts receivable and accounts payable and you know, prepayments that we've made, and you know, what is that electricity bill come in yet? Like we're just trying to, as simply as possible, get down all the major cash in, cash out categories, so that when an investor asks you, when you're sitting awake at night thinking about your cash flow, that you have an answer and you can think to yourself, well, you know what? Based on what I did in the financial model and all these new strategies that we just modeled, I know that in worst case scenario, I'm looking at 6 months. Okay, so probably I should think about fundraising now, right? Or if we wanted to say tone it back a bit, we can maybe get to 9 months. Okay, but at least you have bands of, you know, like reasonability, right? Between 6 and 9 is stronger than saying I don't know, right? So let's not make it too complex, but let's definitely get into a level of detail that it's has the ability to mirror what it is that you're actually trying to do. So let's say this was month 1 now. This is where we get the columns across. Mm-hmm. I don't know. Let's go to 5 months just for the sake of being able to show you. We're going to bring that across here. I'm going to freeze this top pane. I'm going to freeze this going over. This is Google Sheets, by the way. I should probably mention that. So now you can see what's happening over time. So let's just say sales and cost of sales. Actually, we don't need this. And it's just what I was going to say. Sales and cost of sales were consistent all over all the months, you know, or whatever. Maybe there was a bump here and gross margins go up, because that didn't really, well, that should have gone up. Usually you're going to see your cost of goods sold go up with sales, so it doesn't really matter. Let's just leave it at that. We got all these cash out here, right? And then no more investing. Maybe there was not that non-dilutive grant going forward here, so I want to take that out. And here's the trick. So to get the rolling balance of cash over the years, you need to make sure that the opening balance in the next month is equal to the closing in the previous. Okay, so I'm going to bring that forward, and that's where we're going to see. So I actually want to, I don't know, I want to tone this back a bit here. I actually want to make it, I want to show you what happens when in a more realistic situation. And then we're going to bring the 4,000 here. So here's what happens. First month, fine, 18,000 in cash. Next month, 18,000 minus 7 is the net impact. These are all 7s now. 11 minus 7 is 4. 4 minus 7 would be 3,000. So this company, this model that we created, effectively this is the model, is going to run out of cash in 4 months from today, right? So that's how you read the impact of what's happening at the ending cash balance level, and that's going to tell you, well, we got 3 months. That's the runway. That's what we need to think about when we're going out and fundraising. And it's also going to tell you eventually, once we have enough rows here, how much you're going to need to raise in this next dilutive round. Maybe it's 500,000 right now, or now we're good for a while. But that's the gist of it. So we're going to start with sales. And I got a couple quick ways to do this here, and don't mind me. I'm going to bring over the headers from the sheet that I showed you. And here's what you need to know. I'm going to freeze these columns, So already it's kind of taken shape, right? I leave a couple of rows here so I can just offset the titles, the captions on each line. This driver here is, it's going to show where the numbers in this row come from. And then, of course, the data going across. And you can see this is going to go all the way to 5 years from now. So I'm going to name this sales. Change the color. Okay, so I like to use colored headings for any kind of major category, and then gray color for the smaller subcategories within. So the first thing is always going to be summary data. And then in terms of the sales here, we're not actually going to start with the summary data because you would never, what are we going to summarize? We don't know what we've built yet. So I'm just going to move down a little bit here. So first thing we got to do is calculate. And I'll back up a sec here. There's actually quite a bit of work that goes into getting to be able to even bring up this tab. Okay. So I have a different video on YouTube. I believe it's still up there, called the 6 sales questions. And what's important to know is, consider this. So it's going to be, you need to know your market. Okay. You need to know the product. Actually, you need to know the customer too. You need to know the product that you're selling. That's the first. Knowing the answers to these questions is what's going to help you frame and scope what goes into the sales model, because they effectively create whatever the revenue stream is going to be. I'll show you how in a second. Then you need to know the timing of sales, the frequency, the quantity. That's actually that. And then you need to know the price. And these are the 6 sales questions, is what I call them. So the market is, what market are we selling to in the first place? Well, I alluded to it briefly, but this company is called Oyster Tech. They sell hardware and software solutions to oyster farmers, so that these oyster farmers can monitor their crops. And, their solution allows them to monitor in real time so that the oyster farmers can make good decisions about crop management, stopping losses, lifting cages out of the water so that they can avoid, strong environmental conditions like, say, pollution. There was some runoff from a recent flood or something, so they can pull the cages and avoid that. But the point is, it's a monitoring system. So the market in Oyster Tech's case is going to be, it's monitoring equipment for oyster farmers. The customers are oyster farmers, and the product is hardware and software. You can start to see. So the market is actually, it's not going to influence anything here. It would only influence it if you had different verticals you were selling into. So for instance, Oyster Tech, later on down the road, they are going to sell into not just monitoring oysters, but they're also going to monitor salmon. And given that that's a different market, they would have to come up with a different product as a result, right? But in this case, we're only going to model what's happening for oyster farmers. So I can leave the discussion of that there. The customers are oyster farmers, but if you think about it, and we know this from observing all kinds of mature industries, is that you have, of course, consolidation with some big players, and then you have a whole long tail, so smaller companies that also exist in the market, and there's way more of them than the big ones. But even cumulatively, those smaller players, while they might have 80% of the companies might be small, they're only really impacting about 20% of the industry's revenues, because consolidation says that only a few big winners can win. And that's effectively the power law distribution, if you've seen those. Would love to get more into that, but don't have time today. Look it up if you're interested, though. It's fascinating work and really help you set the stage for what your own market looks like. But the reason I talk about this now is because for financial modeling, you need to know, so oyster farmers should not just be a archetypal oyster farmer. Like, it's not just one size fits all. You can't just say, well, there's 2,500 oyster farmers in North America, which is actually the case, multiplied by my average customer value, which is, call it 10,000 for the sake of argument. It doesn't work like that, because some are very big and some are very small. And those two sorts of companies are going to need different solutions entirely. They're probably going to have different sales strategies that you approach them with. They're going to have different sales time, lead times to actually make the sale. There's all kinds of differences. So I would say one of the most important scoping decisions you have to make early on is whether you're going to shoot for the smaller end of the market or the larger end of the market. This also kind of looks like a direct-to-consumer play versus an enterprise play. And even with an enterprise, you'd still get a long tail of smaller companies. So you need to do your scoping at the beginning. For oyster tech, there are oyster farmers. There's small farmers. There's medium-sized farmers, which is probably like a larger family business, say. And then there'd be like the enterprise, corporate Canada and America oyster farmers who buy up all the lands and have a ton of different oyster farms, okay? So what I would do then, I always do small, medium, and large. So what that has done is that even though we have one market, now we've got 3 different customer archetypes, and they're all going to need their own sales model. Now the product, we got hardware and software. And that hardware and software is going to be sold to both the small, medium, and large customer archetypes. So we actually have, if you multiply it out, 1 market, 3 customer types, 2 products, is 6 different ways that this company is going to make money. Okay. 6 is, I would say, maybe if you can, I would do less, right? Ideally, you would have maybe 1 ideal customer profile you start with. It's very seldom the case at the early stages, because usually you only get to that level of clarity once you're actually in the market and you know who you're selling to. The propensity for most founders at the beginning is to say, I want to show the investor, I want to show myself and my team that I actually understand what's going on out there. So I want to show them all the options available. But what this does in adding too many sales streams is it makes the model complex, and it makes it seem like you don't really know what you're doing, right? Because there's, I don't know, if I say we're going to sell to small customers, maybe that's a farmer, just an independent fellow, or madame who's out there farming oysters. That's a lot different than saying I'm going to sell to the biggest oyster enterprise in North America, right? Who's going to buy millions of dollars worth of this product, as opposed to the other person who's going to buy, a couple tens of thousands, right? It's just completely different, and it takes a completely different skill set. So you got to kind of choose. In this case, however, I did leave all 3 small, medium, and large farmers into this oyster tech model by way of an example, because I wanted to show the difference that it makes to the actual calculation of sales. Now, that's just to get the scope right, just to get the information hierarchy right, so we can actually move forward with some accurate categories. Then there's going to be the timing of sales. That's relevant because obviously we need to know this as we move throughout time. We need to understand maybe sales are here, right? Only in those 3 months, because maybe it's seasonal, right? We wouldn't want to say, just starting in January and roll it forward just for the sake of it, right? There needs to be some kind of underlying business logic that says there's a reason this is here. We need to know the quantity of things being sold. So let's say it was like 10 of these things, and then the price was maybe $10. And that's going to mean that in these months, we sold $100 worth of product, right? Yeah. And if this was a no, then there wouldn't be any sales there, of course. So just a bunch of zeros. So now you can see these 3 questions. What's your market? What's your customer archetype? Are they small, medium, large? And what does that do to your sales approach? What's the product that you're selling? That's what's going to frame up the categories. And then you answer these 3 questions. What's the timing? What's the quantity? What's the price? That's how you're going to get the information actually populated. This same kind of approach really applies to a lot of things in financial modeling. You've always got to know the timing, quantity, and price. But these here, market, customer, product, they're really mostly relevant to the sales model, which is why it's so hard to get into it in the first place. I actually calculate, I write all this down before I put it in Excel. I put it down on paper first. I just find it easier to frame my thoughts and do the scoping and do the categorization of, how do I want this to fit and where, to do that on paper, and then to write it out in the model itself. So I'd call that like a low fidelity mock-up, if you will. And I'd like to go into that in more detail in a different video. So first thing we're going to do is we're going to say, well, small farmers. They're going to have, I'm just going to bring in a whole slew of stuff here. Don't mind me. Okay, so what's happening here is that we have these, here's the categories. Sales drivers. What is driving sales? Like, what activities are we as a company doing that's going to result in sales coming in? And this is what I would call being bottom up, right? Because you're actually thinking right from the actionable, targetable level, what are we going to do to access a small farmer, right? And if you were in software, say, you might call this like a product-led approach to growth, right? Where it's like, okay, well, we can't possibly have a salesperson on the phone with all of these customers because that salesperson costs way too much, when in fact what we need is for these new customers just to onboard themselves, right? And then we'll provide service to the ones who need it, right? And so that's more on the small side of things. On the bigger side of things, it might be very high touch. Maybe you have account executives who are going out for lunch with these people, day after day, right? Different. But the point is, what's driving sales? And in this case, I just said, well, we're going to hire some sales development representatives. Okay. I know I just said don't do that, but like in this case, the small farmer is still a large enough account to warrant a sales development representative hitting the phones, right? Hitting the emails per month, and then converting those emails into the total amount that they can send in a month. Emails converted to leads would be say 5% of them convert to leads, and then you'd have the leads convert to new customers at say 20% rate. You're going to change these around, of course, as you get more information, but just make an assumption at the beginning, and not just make an assumption, but make a good assumption based on what you've heard in the market, what you've talked about with people, and so on. Calls made. So and then all this is going to sum up to new customers in a month. So it would look something like this. I'm just going to bring in the first column of data. Okay, so sales development reps employed 1. That person is going to do 50 emails. That means they're going to send 50 emails this month. They're going to convert to new leads at a 5% rate, which should be this, which means they're going to close 2.5 leads in any given month, which is going to convert to half of a customer, which is a tricky ratio to deal with in terms of new customers because you're only going to get 1, but I could round it up, but I'm not going to at this point. They're going to do the same thing down here. And that's locked in. That's locked in. Okay. So total new customers in a month, it's actually going to equate to 1. So this is saying that for the small farmers, if we hire 1 sales development representative, we expect that they will close 1 new customer in a month. Now what we need is the customer count. So opening customers, say we started with 0 in the small farmers. Customers added from the sales development rep is 1. Pilot customer conversion, we actually don't need that anymore. Customers churn, there's 0, and then ending customers is going to be 1 this month. Now, the customer is going to drive what kind of hardware and software is being sold, right? The sales drivers drives the amount of new customers, then the customers drives what needs to be purchased in that period. And in this case, so hardware sales, a new customer in the period comes on. Okay. And when there's a new customer, they need to get set up with the OT100, which is the hardware component of Oyster Tech's monitoring system. but they only need that in the month that they come on board, right? They're not going to need it recurring. So the price is $10,000. That's locked in there. That's locked in there. And they're going to purchase $10,000 worth of product in that first month. The software runs on customers active at the beginning of the period. So in this case, it's actually zero because we're not going to charge them for the subscription until they're set up, right? So it's zero right now. The average price per month is $833, which is 10,000 divided by 12. So 10,000 annual subscription, zero in sales. Now what I'm going to do is I'm just going to roll this forward. And that's usually what I do is I just calculate the first column and then roll it all. And then what I do is go in and change the assumptions individually as time goes on. So what this is going to do, this needs one thing here. So these opening customers need to be equal to the ending customers in the previous month. Okay, so now what's happening is if every month that one sales development rep is adding one more customer, this is going to count up 3 customers, 4, 5, 6. And what that's going to do is every month at the beginning, you're going to get your hardware sale. Every month at the beginning end, it doesn't matter. We're not going to get too precise with this. We're not going to get more precise with this than what we're seeing here. But if there's 2 customers at the beginning of this period, we're going to charge 2 subscriptions, which is that much money. And that's going to go up over time. So you can see hardware remains the same, but the subscription, because more customers are coming on board, not accounting for any churn, is going to eventually outpace the hardware sales by a pretty significant margin, almost 5 to 1. Okay. So that's it for small farmers, except what's going to happen with the sales development reps, right? So in the model I did already, I'm just not going to repeat all my thinking because it's going to take too long. But what I've done is I've said, well, we're going to hire one more sales development rep in 26 at the beginning. Then at the beginning of 27, and this is aligned with the scale up plans for this company. Again, it's a document that underpins a lot of the thinking that goes into here, and it's actually a document I do in the beginning, which is basically a Gantt chart that shows different strategies and how they're going to scale up as the company does. It's broken into product, operations, and then go-to-market strategy. So I know that this company, the go-to-market strategy is that by the end of 26, they plan to have 25 customers on board, which this would be in excess of that. 36 here. And then after that, by the end of 27, they want to get to 100. So I figured they're going to want to step up their sales development reps in 27 dramatically. And then they kind of just, they increase a little bit after that. The reason they don't keep increasing at a more exponential rate is because this company is going to deprecate its reliance on these small farmers and move up market into enterprise as soon as they're able, right? So what I want to show here is that small farmers by themselves can actually float the company. They can be profitable, and these profits can be used to reinvest into the remainder of the business. But it's not going to be the strategy over the long term, and that's going to show up in the dashboard. Okay, so that's small farmers. Then we go into medium farmers. And this one's it's where it gets a little bit tricky and interesting, I think. So what matters here is that with the customers, there's actually nothing that precedes them anymore. So up here, we've got these sales drivers. So sales development reps are employed and they do these emails and make these phone calls. At the medium customer level, it's no longer possible to do that because these accounts become quite large. So the annual contract value for a medium-sized customer account is about $80,000. And if I were to just say, well, I'm going to have a couple sales development reps, they're each going to successfully onboard 1/20th of a medium-sized farmer in any given period. It just doesn't make any sense, right? What's actually going to happen is that a business development rep is going to go out, pound on a bunch of doors, get a bunch of contacts, work those contacts in the CRM system and track their progress towards a completed sale over time. And those sales are going to complete at some schedule that we just can't know right now, right? There's just no way to do the timing on those. And I've tried to get into a finer detail for larger business to business contracts, but it's just not worth it. But there are things that we can do to make it somewhat believable, right? So that we're not just throwing stuff at the wall and seeing what sticks. So for instance, this first customer added for the medium farmer is going to be that pilot customer that Oyster Tech has. So that's got some business logic behind it. And the reason that matters is that if you're going to be talking to an investor, you need to be able to tell them why this number is there, right? You can't just say, well, we're going to get 10 customers in the second year. It's like, how, right? So that's going to be Hume, which is the pilot. And there's going to be the second customer here. Why is there a second customer there? Because the company, Oyster Tech, is going to be ready to take on more at this point in time once they've completed their pilots by the end of 25. This customer here, the new one, if anyone said, well, where does that customer come from? How can you be sure? What I would say is that your sales funnel is what's going to drive this. But basically what you got to do is you've got to have 3 or 4 different stages in your pipeline. And this is more for B2B. So if you're going direct to consumer, it's not so relevant for you. Different things are relevant for you. But for B2B, you would have the sales pipeline saying like, look, if our sales cycle is 6 months long, that means the newest contacts we make would be in that first bucket where it's like 6 months to close. And then there'd be a second bucket, which is, we've started contracting with them a little bit, contracts back and forth to, assess, whether they're happy with the terms or you're negotiating the terms. That would be like, 4 months left to close. And then you'd have another bucket, which is, moving to close, where it's, would be something more like, we've settled on the initial terms, lawyers got involved, we're talking implementation timelines now, these sorts of things that are really moving along. And maybe that's 2 or 1 months to close. And then there'd be the final bucket in your sales pipeline, which is imminent closing. So it's just waiting on final signatures or something like that, right? So it's not quite revenue, but it's really close. And what I would say is that if you can build out that sales pipeline for B2B, that's what's going to be the fuel for any of these projections that you're making here. So you can actually, like I say, I tried to quantify that whole sales pipeline in the actual model, but it becomes a real mess really quick. So kind of against the principle of keeping things simple, very much against it. But if an investor asks you how you get these here, you want to show them your sales pipeline as backup. For direct to consumer, the equivalent of this would be to say like how many pre-sales you have, how many maybe newsletter folks you have on your newsletter, how many wait list seats you've sold. Those sorts of things would be the fuel that then says, well, that's not quite a sale, but it's really good indication that this is going to be a sale in some reasonable period of time in the future. And then you just manually put this in. You can see it's manual here. Ref, by the way, means reference. So this number's coming in from somewhere else. Manual is just you're going to input it, and then calc is calculation, right? Okay. And then what happens here again is the same thing as above, so I don't need to repeat it too much. But what's different here is that as you move up the size of customer, now it's not just one OT100. On average, it's about 7 that are needed. And that's going to result in $70,000 worth of hardware sold whenever there's a new customer added. There is a mistake there. It's not going to count that new customer from the pilot because the pilot was already enacted before, so the money wouldn't come in there. So it's actually not a mistake, but it should be. But yes, the new customer here in Feb, that's going to cost, or that we're going to earn $70,000 on the hardware sale, and then the monthly fee for them is $70,000 as well. So, annual fee is $70,000, so monthly fee is about $6,000, and that's going to continue to recur, so on and so forth up here. And you can see that these customers are going to add up to about 35 in 5 years' time. So not quite as many as the small, but way more consequential when you add up their hardware and software sales in any given month. 264 as compared to, never mind, I take that back because there'd be 288 customers in the small for about the same amount. But you can see based on about the same amount of monthly sales between small and medium, it takes 288 small customers as compared to 37 medium customers to meet about the same sales results. So you can imagine who you want to work with more. And it depends. But in this case, medium and large are better for Oyster Tech. And then for large customers, very, very big emphasis on the large customers too. This right here is saying that by year 5, there'd be 20 large customers as well. The question is, well, they can't all be very large, right? There should actually be like an extra large category where there's only actually like 5 companies in the whole of the market. But I just didn't want to get into that level of more rows than I never do in my modeling. So I try to keep it to only the 3 archetypes here. But these 20, I mean, even they would have a power law, right? Like the top 3 would be like so large that it would blow apart the model if they did come on board at any point in time or they left at any point in time, right? So it's just not worth modeling them. So I just take an average of, say, whatever the top, 50 companies out there would be. They hope to have access to 20 of those, right? So about 40% penetration at the top side of the market. And that's really the only constraint is it true that Oyster Tech could add 1 large company per month down here? Nah, maybe, right? The biggest constraint is whether there's even that many large companies that exist. The other constraint is could they implement them that quick if they're going to be selling, 10 units of hardware that need to be tied up to all the different parts of the farms and different geographies and so on. So it could get pretty complex, I think. But most of the time, you're not going to have a lot of conversations about what's happening in years 4 and 5, right? Most people are interested in what's happening this year and then next year too, right? Whatever's happening during the term of this next phase of financing that you're raising for is always going to be what's more interesting for investors, right? So then you get to the bottom here and, okay, so 20 large farmers is actually quite a bit more money than the medium. It's about, I call it 2.5 times as much with only half the companies. Again, you're going to use your sales pipeline to say, well, there's actually some credence to these customers being added at this point in time. And they're not going to start until January 2027. Okay? A couple other things I do here. I like to cancel out all the rows at the bottom. And then in terms of formatting, what I would do is take away the grid lines. And then what we got to do is go to the top. And here we're going to put in the summary data. So I'm going to add a few rows. We're going to come in sales summary. I'm going to copy her over. So maybe I'll just bring in the titles here. Let's bring this over. And so from small farmers hardware, that's the first thing here. Then from medium farmers hardware, from large farmers hardware, small farmers software, medium farmers software, where'd you go? There it is. Large farmers software. Okay. And put a couple lines for when you total something up. And do some sum functions there. Comma in between if you need some space. Okay. I want to make all these Barlow formatting, 10 font. It's adding up just fine. So what I'm going to do, I'm going to fill this over now, and that's going to give me my total sales projections. You can see that hardware at the end of this, at a more mature state, is again about 1/5 of what software is going to contribute to the company. But at the beginning, hardware is much more important in the first year. In fact, it accounts for $120,000 worth of sales compared to only $55,000 in software. So there's an inflection point where the software starts to take off with that exponential growth pattern because there's more companies being added, whereas the hardware is going to stay flat and just enable that software growth. That's how you can think about that. There would, of course, be some repeat hardware purchases for, say, units that get damaged or units that need maintenance, or people want to expand their farms. But we're not gonna model something like that that's so precise. Not at this stage, anyway. Not without actual data. Because even if there was things like that happening, you got to think like in terms of Does that matter to the model? Like the answer is no, right? Because even if you were going to have something like repairs and replacements and people expanding their farms, maybe that's like 20% of hardware sales, which is already only going to be 20% of total sales. So what you end up with is you're fighting over 4% of total sales, which is just, it just doesn't make sense, right? Don't care. Okay, so that's how you do sales. That's the biggest one. Okay, like this is, if you can get, frankly, if you can get the categories of customers that you're selling to in whatever market you're selling, and if you can break these categories down into what's driving sales for each customer archetype, how many customers you're going to have, and what you're selling to them, when that sale is going to happen, the quantity of whatever it is that's being sold, and what you're selling, what price you're selling it at. That's the by far the majority of the work that's going to happen here. So give yourself a pat on the back when you get to that point, because the rest of it, it only gets easier from here. Okay, now we're going to move into cost of goods sold. It's not quite the right color. Oh, it's supposed to be blue anyway. Okay, again, I'm going to make these all the exact same size. I like 20 pixels on the first one. C doesn't matter. It's just whatever the title size is. D and E and so on are going to stay the same. I'm going to fix these. I'm going to fix that. Actually, this needs to be... Nope, that's good. I'm going to bring over my cost of goods sold. Just so you don't have to watch me type all this stuff out. I'm not going to just replicate... just type everything out again, especially, like I say, I got this Mac now, and I don't know any of the commands or hotkeys, so just using it because the video is a lot better here than my old PC, but not PC, laptop, Windows. But it's giving me some technical challenges, so I hope this comes across okay in the end. Okay, we got some summary data. We're not going to do that yet because we don't have anything to summarize. So the question here, the big question with cost of sales is, well, first off, what is it? So cost of sales is any cost that you incur as an organization that is specifically related to the sales that you're making. So for instance, in this case, there's hardware being sold. Well, the cost of sales for the hardware is whatever materials and labor went into making that OT100 hardware unit, right? Because without incurring those costs, you could never make the sale. And that's a good litmus test for what cost of goods sold is. You know, if you incur the cost directly on account of making that sale, that's a cost of goods sold. It's a little more ambiguous in the software side of things. So for instance, you know, would a salesperson be accounted for in making that sale? The standard answer is no, because that salesperson is going to have a salary no matter what. So they're not directly attributable to each sale, even though they're the driver of that sale, right? But without that salesperson, something still could have been sold. Maybe the founder went out and did it, right? But for the software in this case, and generally for software companies, one of your biggest costs is going to be hosting, and you're probably going to get some credits for that. But at scale, you know, hosting all this data in the cloud, right? Like in this case, a monitoring company, you know, like collecting all these data streams, it's going to cost a ton of money on the hosting side, and therefore on the cost of goods sold side. And really the reason that matters is because if you're allocating resources to cost of goods sold, your margins are going to decrease, right? So you want to, within the bounds of what's reasonable, put things in cost of goods sold that are directly attributable to the sale, but then you want to keep other things out and put them in operating expenses and call them business overhead. This isn't going to impact your net, you know, cash balance at the end of the day, but it is going to allow you to say, well, we have 80% margins versus we have 65% margins, right? Obviously 80 sounds better, and you probably want to push towards 80 to the extent, again, that it's reasonable for your business. And what reasonable is, well, you can find that online pretty easily, right? And so check it out depending on what you're doing. And it also is a good benchmark, right? With your gross margins, you don't want to just like stack them up and make them look unreasonably high, because that's really going to stick out, right? And like if you're a company that produces hardware and you're saying our margins are going to be 80%, whoever your investor is going to very much doubt that. So the first cost of goods sold category is hardware and installation costs. So what I've done in this case is I've actually inverted the data where it says for a small farmer, there's going to be an OT100 purchased. And this information is coming in from sales, which is going to be up here, OT100s purchased needed in the period. Okay. Because they needed one in the period, the cost for an OT100 is $7,000. That's going to be arrived at by saying, what are all the materials that we needed to purchase, like the bill of materials for an individual unit of hardware. What's all that sum up to for an individual unit? You're going to have a unit, like a techno-economic model would maybe feed that. Or just like I say, a bill of materials, right? Whatever you've been doing with your prototyping or alpha versions, like you're going to have a bill of materials that say it's going to cost this much. And you're also going to allocate some labor, for the technicians who have to then put it together, right? In this case, I just went straight to 7,000 as a top line number, but just know that you would, of course, need a backup for what's in that number. And another point to be made here, cost of goods sold is usually driven directly from sales. So there's something about sales that initiates the need for a cost of goods sold in the first place. So in this case, in all cases, it's small, medium, and large farmers are purchasing these OT100 monitoring units. I picture them as this just this box basically that just collects data and floats on a buoy system, right? Floats in the water, or it attaches to the oyster cages in some way. Give you some idea there. So it's 7,000. Doesn't matter who it's for. It's going to be 7,000. But what changes is two things. The installation costs are going to be different for small, medium, and large farmers. Okay. And the number of units purchased is going to change fairly dramatically. So if I just go over, I haven't linked it up yet. 1 second. So medium farmers, I'm going to go over here to the OT100s needed in the period. And then same goes for large. Okay, we're going to fill these over. My mistake, that's not the one I needed to click on. Yeah. Okay. I actually didn't. Hold on. So what I need to do is that multiplied by that. So this is going to be, medium customers are going to be the new customers in the period times the amount of OT100s they need. And that's going to give me the number I actually need to put down here. Okay, good. And then not sum, just equals. New customers in the period, each one's going to buy 25 OT100s. Okay, so now we're looking at 25, 10. Why is that 10? Oh, right. Okay. It's been a while since I looked at this. So here in the scale up plans for Oyster Tech, usually what you'd see is that for a hardware play, it's more expensive to run at the beginning, and then over time, costs are going to come down and make this a more scalable business, right? So one of the things that I had in the business plans was that in the middle of 27, they would get to a V2 of the product, which would cover more range of farm with the same buoy. So there's actually, for individual large farmers, they don't need 25 for that same area anymore. They only need 10 buoys. And so that's why that decreases over time here. And then, yeah, that's good for now. So that's that. So now we got these OT100s purchased, right? I'm going to go back to the beginning here. For a small farmer, they're going to get one, $7,000, $1,000 to install. Total cost to us. This isn't sales anymore. This is our cost incurred and cash out is $8,000 for that. For instance, with a large farm, it's going to cost us $185,000 to do that. So that's the hardware and installation costs. Now we've got another category here, which we're also going to frame in terms of in terms of small, medium, and large farmers. So a small farmer, customer, right? So this is the driver now. And cost of goods sold have drivers just like sales do, but a sales driver is for sales, and a cost driver is for cost of sales. And the cost driver is going to be driven by the amount of things being sold, right? And so what I'm doing right now is saying, okay, small farmers, the amount of customers is going to dictate what the support costs are. So if I go back up here, I've got, I'm in the small category again. I'm going to have ending customers as 1. And by the end of it, we're going to be at 288, right? So you think to yourself, how many customer support people do we need for that? Well, let's say that one customer support person can handle up to 50 small customers. So by the end of it, we're going to need 6 customer support staff. Each one of them is going to have a salary of $5,000 a month, meaning $30,000 a month burn rate for the support staff. And this is going to be the same for medium farmers. So I'm going to come down here. Ending customers on the medium, and then ending customers on the large. They're all going to be paid the same. It's just that now, instead of one person servicing 50 small farmers, it's going to be actually 5 people, or only like maybe like one customer success role could manage 5 accounts of the really big customers. This is all going to change with AI, of course. So I can't really model that, but I'd say look, in the future, if you're going through, right, and you're calculating all these types of costs, I would actually be given thought to, can you use AI to replace some of these? So maybe small farmers, they wouldn't get access to an individual person. They'd get, the AI avatar or whatever, some kind of agentic system that's going to just do this at, $5,000 a month total, right? And so when you think about the whole scope of the business like this, you start to see opportunities to save money using new tools like AI. For now, we're just going to have people in here. That's support costs. And the last category here is hosting costs. Okay, so just going to delete these rows because I like to do that. So monthly costs for small farmers for hosting, I'd say $100 a customer. Medium would be $600 a customer. For large, they need $4,000. Because I left these manual, you can make adjustments year over year. If you think that hosting costs are going to increase later on, you could do that. But what's happening here is that these are being multiplied. So one small farmer times $100 per farmer equals $100. Over here, now we got 2 small farmers times $100 is $200, and so on. I believe these should all be working because they're the standard sizes. Okay. Now it's going to calculate our hosting costs by the end of it. Now we got to go to the top, roll all this up into a summary. It doesn't matter how you summarize this data, by the way. Something logical, whatever makes sense for your own analysis too. Maybe you're more interested in how one thing works over another. All right, that is how... maybe you're interested in seeing the cost structure in a certain way, So maybe you want to see the proportions between like hardware installation versus support versus hosting. So you're going to set it up like that. If I wanted to, I could invert this again and say costs due to small farmers, costs due to medium, costs due to large. And the reason I would do that is that I could see, I'll give you the 2. So if I do this on a hardware, support, hosting cost basis, I can see the proportions of the costs relative to one another, so I can understand what my most important cost is going to be. And if it is, say, support, I know I want to focus on getting an agentic system to come in and reduce that cost to improve my margin the most, right? If I did this on a small, medium, large farmer basis, I'd be able to see gross margins for each of my small, medium, and large farmer customer segments, right? And when I can do that, maybe I'd say, well, actually small, I'm only making 30% on a sale, whereas large, I'm making 50%, right? So then I want to shift my focuses to large, right? There's quite a few more details that we need to go into that kind of calculation here, but just gives you an idea that you can flip this data, slice it, dice it, however you want, up to you and whatever your business needs are, pretty much. So hardware installation costs from small farmers, okay. From medium farmers, from large farmers, support costs for small, medium, large, and then hosting costs. It's already lined up there, so I'm just going to drag that down. Okay, I'm going to put a couple bars here. These just signify, I mean, I probably said it already, I can't recall, but it signifies adding some, yeah. I'm just going to make all my formatting the same. Flow that over. Okay, so now just at a quick glance, hardware installation costs are about, let's just do proportionate analysis. So here's, just like a little thing I might do. Yeah, add some rows. Little thing I might do just to understand my cost structure better. So I'm going to say total, percent of total COGS. So hardware and installation costs, percent of total is going to be this divided by this. And I'm going to lock that cell there. Can't do my hotkeys. That's going to go there. That's going to go there. Okay. Fill this over. By the way, fill, control copy, control shift over, and then control paste. That's how I'm doing that there. So now, at the beginning, actually the whole way through, hosting seems to increase over time as a percent of total. Support, that's probably because support costs become less as a percent of total because they're becoming more efficient because more people can serve, it becomes more efficient because an individual whose salary is fixed can handle more customers. And eventually they hit their capacity, which is the theoretical most efficient, right? So these folks in support are becoming more efficient, handling more customers at their fixed rate of salary, meaning that their costs are going to decrease as a proportion of the whole over time. And then for hardware, software, I would imagine this stays fairly consistent. It's kind of tough to tell because it's going to jump up and down based on when there's say a medium farmer came on, right? Well, suddenly that's quite a bit different. So you kind of have to look to the end state in 5 years to get an idea of what this business strategy might look like at maturity. And that's actually a point. And just realizing now that's why this matters to go that far into the future. Because it really does give an idea of what this strategy looks like if you were to extrapolate it. And when you do that, it makes your business strategy comparable to more mature companies who generally have data available to the market, right? In more data available to the market. So you get an idea of what the future could look like and whether these strategies that you're doing today, if enacted, what they extrapolate into and whether that's in line with what's expected for the sort of industry that you're in. Okay. And I would say it makes sense to have half the cost of sales framed up for hardware and installation. Okay, that's it. So now I just want to quick show you here. Okay, don't want that there. So now what we've done is we've done the sales subschedule and the cost of sales subschedule. Those are going to flow up into the cash flow summary. Okay, and we can calculate gross margin now. But we got to do the operating expense subschedule, so that's got to come in. And I want to do that detailed tab before we move over to rolling this all up. So let's make a new sheet. Not that one. OpEx, operating expenses. Do my column sizing. Let's see, you're going to get bigger. This is going to go to D. This is going to go to 4. And then we're going to bring in the operating expenses. Got a different color for this one. Oops, not there. Put it there. Different color because it's below the line of gross margin now. These are business overhead. These are quite a bit different. Like these costs are now fixed mostly. They're like semi-fixed or fixed. So for instance, there's going to be, we already know for startups, like 70 to 90% of their expenses are going to be based on people, right? So either that's full-time people, it could be consultants, advisors, professional fees, advisors, like board members' fees, all these things. They usually account for the lion's share of what the operating expenses are for a startup company. So we already know it's going to be highly payroll related. And because it's payroll related, these things are going to be fairly fixed, right? And so there might be some folk like myself as a fractional CFO who work for hourly or sometimes fixed contracts. But the hourly would move quite a bit. Whereas if I had a salary, say I was a CFO who was on salary for one company, my rate's pretty much fixed throughout the year, right? So you're going to see a lot more fixing in the operating expenses because the costs are more fixed. And you're going to see a step function when they do increase, right? Because they're going to increase in big chunks. Say someone got a raise, now it's going to step up and it's going to be that way until the next raise, right? Whereas cost of sales, they tend to be variable and they scale with sales. That's another way to tell which cost might be best attributable to which sort of category. So we're going to bring in operating expenses here. That's a summary. To give you a little sneak peek. I'm not doing all the bells and whistles on this one. Like I'm not going to count up employees right now. I just want to get to the straight up cost stuff. Okay. So we've got research and development. Sales and marketing. General and administrative. Let's call it admin. Okay, that's those categories. And then, of course, we got to now create these. And then we got this OpEx recovery, which is going to be like payroll recoveries, right? Depending where you are in the world, they're going to be called different things. BC, we got MyTax, for example, is a big one. IRAP does a lot of payroll recoveries, that kind of thing. So OpEx calculations, research and development is the first. And then here's what we're going to do. To keep things organized nicely, I always start with the salaries because they're going to be the most consequential, as we've discussed. For Oyster Tech, they're going to have these salaries. They're going to have a chief technology officer. The salary is going to be manually inputted. They probably all should be manual, frankly. The reason that I put in the costs here is because when I just going to lock that cell, I can just change, if it was 9,000, it's like, okay, now they're all 9,000, right? And that's the reason I put that in the driver in the first place, so you can see where that number comes from and adjust it easily. But over time, what I've realized is that these things are better to do manually, even over a 5-year period, because you want to see that step up, usually as a result of like raises or inflation or what have you. And you can't do that if you just fill that one column right across, right? You would need 5 drivers, one for each year, which would make this even bigger, and I wouldn't want to do that. Yeah, it's just more complexity than is needed because it's actually really easy to put these things in manually, right? I'd put like 1,000 across, and then I'd say, well, maybe in this year it's going to be 2,000 and so on. So there's no problem in like doing that, right? You're not saving that much time adding a bunch more drivers. But just because I have it done this way already, I'm going to pull over what is, and we're going to go with that. So what's going to happen first off is we're going to subtotal the salaries, and then we're going to add the burden on the salaries separately. So this is things like your benefits, payroll taxes, paying for workers' compensation, all those other costs that come on top of the salaries for an employee. And I'm going to bring over the cost now. Not like that. Okay. This should be locked still. That's that. That's 13% on top of 20,000. Perfect. So all the way up. So this is going to be so the interesting part of a operating expense model. You can see the positions right now. This implies there's 3 people working for this company, right? Or there will be at the beginning of 25. Now you can see if you keep going over, it's all the same until January 2027 when a software lead is hired. So this is effectively the hiring plan quantified, right? You wouldn't want this to be the hiring plan. You wouldn't want this to lead to the discussion of a hiring plan. You would want that in a separate document in the data room. But you need this to agree to what it is that you're saying in that hiring plan, right? You need everything to be telling the same story in terms of timing and costs and so on. Okay, and then the other thing is that really this is going to be like, these are not all the salaries on the R&D team that are going to be needed to get this company to servicing something like 500 customers, was it? It's not going to be a team of 6. Well, if they were just scaling the same product, maybe. And then the team would shift more towards sales and marketing. But, they're talking about, Oyster Tech's talking about doing different products, like a different data sales and making a sophisticated data play out of all of this data that they're collecting. So there's going to be a data team. There's going to be, I don't know, all kinds of roles that I haven't estimated here. And the reason I'm saying this is because, you don't really want to get too deep into that, right? Like you're not going to go do an analysis on, what are the 20 types of people I need in year 5 for this business model, right? It's a waste of time at the beginning, but what we do need to do is have some conception of, what those costs, might total, like what the aggregate costs might be. And that's what I'm pulling in here. So I can say more about this later, but basically if I were to run this forward up top here, these 6 salaries to the end, what it's going to look like is that this isn't much cost if they're making, what's the sales at the end of it, right? Sales at the end is, I'm showing $1.3 million coming in the bank, subtracting 462 in COGS. So that's about $1 million. That's really annoying. Bear with me. That's about $1 million. In margins in a month at the end of year 5. And then that $1 million is only going to need to pay for, 50,000 worth of salaries. There's no way. Like, this would be an insanely profitable company, right? So what happens is that the cost structure never really gets fully formed in the later years because we don't have individual instances of the folks who we're going to need to hire at that stage of the company's life. So it looks like way too profitable in the future. It's the same shape. I see it every single time, especially with the recurring model. The recurring sales goes up, the costs kind of keep up. That means the margins went up significantly. And when there's not that much OPEX to cover, that all goes to profit, which is not actually going to be the case because there's going to be salaries in there. We just don't know them yet. So what I do for each category, R&D, sales and marketing, G&A, is that I subtotal all of the costs above the line, which could be salaries and then the other materials that these folks are purchasing. So there's going to be a human element and a materials element to the fixed cost. Subtotal that. And then what we're going to do is say, this is a bit of artistic work here. I was going to say black magic, but maybe I just should. Expected additional staff required. So this is, saying, okay, look, we don't really know yet, but we think somewhere in the future there might be. And in fact, I didn't add any more for the R&D team. So I must have come to the conclusion myself that this is a good enough R&D team. But what would happen is, say, in year 5, maybe there's like 2 more people we know are going to need to be added. The average cost of that person who is going to be a team member, but we don't know who they are, is $9,000 a month. Means $18,000 in additional staffing costs that we can't budget specifically for a specific hire. And then there's additional departmental costs, which are reflective of the things that those 2 people would need to do, or the budget that they would spend to do their jobs. Why do I know it's 20%? I don't. But I have an idea because, like I say, usually startups are spending about 70% of their money on people in the earlier stages. So maybe this would actually shift to, call it 40%, right? Because over time, now that we're in year 5, these folks, are going to become, they're still, the payroll is going to be one of the largest expenses by a landslide. But so too will they probably need to invest in more expensive tools and materials and such to do their jobs. So, and like I say, if salaries are 70% of the cost structure, that means 30% needs to go somewhere else, and that's going to go to this. So this just basically adds in, what we can't see on an individual basis, just based on headcount that we think is going to need to be in there. On those scale-up plans, I was telling you about the Gantt chart with the product swim lane, and then the operations swim lane, and then the go-to-market swim lane. Those roughly track back to the different categories of overhead. And in those scale-up plans, I put a little marker for how many employees I would expect in each one of those years going across for each function of the business. So I have a bit of an idea looking at that Gantt chart, what this in practice could look like. And another check I do is that at the end, if we're looking way too profitable, I come back here and I assess, well, at a mature state, would this company actually incur a lot more salaries here? Well, yeah, probably. And then, I take a look at the ratios, right? And so say that operating expenses are looking like 5% of sales. That's way too low. Maybe I want to get that up to 20% of sales. So I just add in headcount until it's about 20% of sales, right? That's the way I go about doing that. So the rest of this, so that's sales and research and development. There's going to be 3 more categories. I'm just going to paste them all in right away. So sales development reps at the beginning from small farmers, that's going to be tied back to what happened, to make sure you're always on the right column, by the way. Hire that person there. And then they have a cost associated with them. Okay, it's going to calculate the cost. These are individual people that we're going to hire over the years. So we're going to sum up. We're going to add burden, subtotal. Good. Marketing salaries, there's a couple of them. They're not starting until 27. Okay, good. Advertising, it's 1% of sales. So I need to set that. So I'm going to call it 1%. I'm going to lock it on the column. I'm going to multiply sales by that. And am I going to do all sales? Yes, I am. So that's that. Advertising budget as a percent of sales, same deal. Also, I'm realizing I want to take my grid lines off here. I was going to say, the reason, the fact that this is all standardized allows me to just fill over information without worrying about it, right? If I'm going to go back to the beginning here, what I just did, I know I'm on January 25, right? So, okay, software, I'm going to redo this. 1, 2, 3, lock that one in. I need to multiply by sales, Jan 25, right? Okay, that's that. And then I know when this flows over, I'm referencing apples to apples. The April 1% 2029 is actually agreeing to April 2029 sales. Very important to get those things right, because once, the last thing you want to do is show anyone else a messy model, and then they're going to have absolutely no confidence in it. And neither should you as the decision maker, right? Data purchasing. This is going to start. It's $2,000 a month starting January 2027. Okay, so external data. And then travel and events. So you're going to see a lot of this. This is going to be driven, again, this is one of those quote unquote materials that the people are using to do their jobs. So as the staff increases, right? And so 6 sales development reps, a sales manager, business development rep, sales coordinator, you got 9 positions there, people that are probably traveling around because you need to meet these farmers where they are and go to their parts of the world is what I determined in the go-to-market approach. Also in the data room. So these costs are going to step up. These travel costs, these event costs are all going to step up in somewhat of a looser connected way to the salaries on the payroll. You can't do a 1-to-1, I can't do a fraction of an event, but you can use some just reasoning to come up with a plausible number. Okay, same deal. Sometimes I like to check the formulas here just to make sure, because if I copied something wrong, it would show up here. So what we're saying is total sales salaries, total marketing salaries, advertising, travel, and events, it's all going to sum up to this. I don't need any additional deeper projections at this point, so the subtotal is the total. Down the way here, I actually didn't add any more deeper projections for sales and marketing at all. So there we have it. We know the team for the next 5 years. Quote unquote know it. General and administrative. Let's make sure it's working. Yeah, looks good. Professional fees, fractional CFO, just talking my own book here. Bookkeeper. Oh, by the way, fractional CFO depends on the size of the engagement, right? So as the business needs increase, so too with the expected fees in a month. And same goes for bookkeeper, same goes for legal. These things should all step up over time. Again, the step function. Miscellaneous. Rent goes up. Here's where they get into a new facility at the beginning of 26. Freight and whatever. I would put more effort into like making these things exact, and probably I would look at the income statement for the company I was working for if I wanted to make it more precise. But for the purpose of a fictitious company, I think this is sufficient level of detail. This one I do need to change right now because this wouldn't have copied over. So subscriptions as a percentage of sales, which might not be the best driver, but it's a driver nonetheless. It actually comes up with a pretty good total, I think. Yeah. Okay, let's make sure this is adding. Okay, subtotal, it's working. Yep, salaries plus consultants plus miscellaneous equals your G&A, and then we have a couple. So here's where I actually did add in a few more staff in the deeper projections. So 1 staff for 27, I'm not sure who it is, but they're there. 2 for 28, and then 4 for 25. So I'm actually adding in my subtotal G&A, the things that I'm expecting based on what I know today is $65,000 in a month. For the things I don't know, I'm expecting about $40,000 in a month, which is actually a pretty good coverage of known to not known, I would say. Final thing, recoveries. This is my prompt to delete that because I don't like it there. That's kind of nitpicky, right? But you do something enough and you kind of get used to your way. That's what I find for me, I should say. Payroll recoveries, you would have a much more precise analysis of this. So, say I'm in BC, Canada, right? So payroll recoveries, you'd have MyTax and IRAP, and you'd have maybe, if you're in the life sciences, you'd be working with Natural Products Canada, and all these funders can actually pay for specific salaries that are higher up in this model on this sheet. So I would put these in there, and I would actually drive the payroll recoveries based on those salaries, right? In this case, I just added a flat 10,000. For Shred, we got 80,000 in the first year. That's going to be, again, if you're not in Canada, this isn't relevant, but we get money back from the government for engaging in research and development work. So in this case, this would actually be driven from the research and development team, which I would, again, generally do. In this case, you can see it's coming from, it's about 40% of the enhanced rate multiplied by the, I'll show you, I came this far. I think I'll show you. So I'm adding up all the total R&D salaries and then multiplying it by that percentage, right? So I want to see the recovery there. Okay, 112. And that's enough for an estimate, right? Plus or minus 40%, that's probably about what it's going to be. And so then I can keep doing that going forward as well. Okay, I'm going to get rid of grid lines. I'm going to add up total R&D, total sales and marketing, total G&A, total. This OPEX recovery's got to come in at a negative value because it's offsetting the costs. Okay. sure that's all right. Okay, cool. One more sheet here, folks. So now we're going to bring this all together. We're going to call this the cash flow summary. Dip back over real quick to the... Nope, not that either. So now we've done the supporting schedules. Now we're going to bring all that data in to the cash flow summary so we can calculate cash balance. Okay, bring that back up. You know the drill. Bring it down to 4, bring it over to D. We're going to extend the C. That's a little too much. Yeah, bring that over. Okay, good. One nuance here, when you get to the end, I have a annual counter. So this is going to be the summary of this monthly information in annual format for financial year 25, 6, 7, 8, 9. And then this is what's going to move over to the dashboard when I do create it. I'm not going to do it in this video for the dashboard, but you want to have some kind of annual counter here. I'll show you why. Okay, so let's just get started with calculating the cash balance. That's the net impact of this sheet. Bring in the color here. We're going to start with sales. Okay, so pilot sales, we remove that. Hardware sales, let's go find those. So hardware sales, software sales, let's find those. Don't need the total because we're going to add it here. And then the annual sales growth is just going to be NA because I can't do that on a monthly basis. I'll do it on the annual. Okay, so we're going to do that. I'm going to fill that over. We're not going to fill it to the end though. And now what's going to happen is I need to do a sum if formula. Don't worry about following along if you're not used to the formulas here, but what I'm trying to do is sum up all the monthly information into these single columns based on a certain criteria. So what I'm going to say is these rows here, if they equal 1, 2, then I want to sum these dollar values, which I'm going to fix that by column. I think that should work. That can come over. Okay, let's give it some formatting, see if it makes sense. You want to do some gut checks too as you're going about all these things. So one of the ways to do it would be, okay, well, I want to see, do I know that these are actually summing up all the 12-month periods accurately? Well, let's see. At the bottom right-hand corner, the sum, 6.53 million. Let's see if it's the same over here. It is. Okay. How about the total of both? 23,302. 23,302. Okay, so my formula is working. And now for the growth year over year, that's going to be that minus that. So current year minus previous year divided by previous year turned into percentage. So what this is saying now is that this company is growing 6 times over the first year, 3 times over the second year, 2 times over the year before, 2 times over the year before. Okay, so this would be like a pretty traditional what you would expect in like a kind of venture capital math. It's kind of like at least doubling the business every year would be the first proxy that you'd want to look at in terms of sales that excite people. This is a bit of top-down thinking, but you kind of got to do it. It's kind of like you want to build everything from the bottom up and what you know to the extent possible, but you also need to consider the constraints that are in the marketplace and kind of apply that top-down thinking too. And what you end up with are these like minimums and maximums, and kind of like you're boxing in the answer to what could be plausible. And you're kind of talking about that range. When you talk about individual numbers, we're never going to be right on. But if you can be within 20% up or down, that's pretty good, right? Cost of goods sold, we're going to get rid of pilot costs again. We're going to bring in the hardware and installation costs. Okay, we're going to bring in the support costs. Looks like that. Hosting costs. Okay, then we're gonna sum of that all up. I'm actually gonna make these negative now just so we can keep track of what's cost and what's an inflow. Okay. Just going to do this pretty quick as I can here because I don't want to spend a lot of time making you watch me do calculations. So that's cost of goods sold, and then we come to our gross margins. Okay. Let's put another bar up top here. Border, whatever. So our margins in the first month are going to be negative. That's fine. How negative are they? 31% negative. Why? Mostly because that support staff right there. So you got to pay them their wage, no matter how many people they're talking to, 1 or 50. But they're actually driving gross margins negative in the first couple months of this model. Doesn't last for too long. It just lasts until May, so 5 months in, and then gross margins become positive, and they stay positive thereafter, growing in fact to about 65% eventually. You can see on a annual basis what this looks like. Yeah, not great in the second year either. Although I don't think this is right suddenly. And there's a couple small differences between my other calculation there, but that's fine. They end up at about the same place. It's just most of the pilots throwing it off. Okay, so I'm back. What do we got next? So we go gross margins, and then we're going to go operating expenses. I'm going to bring that in. And I'm also going to bring in the cash flow before taxes. So we're on January, so we're going to roll over here and get research and development. That's going to be a negative. Bring it down. That's going to capture the other two. That is a subtotal. That's a subtotal. That's a subtotal. They all need borders up on top. Sum these up. And then I'm going to also go to OPEX for this. Another negative, which is going to make that now positive. A cash inflow for the recovery. And then we got negative 44,000 in overhead cover. So now our cash flow before taxes is going to be the sum of the margins that we earned, which are supposed to be contributing to paying for this, but in fact the margins were negative, so they're detracting from the rest of the cash flow position of the business. Plus, we only got, or we had to pay another 44,000 to keep the lights on. So this company just burned 47,000 this month. In percentage of sales terms, this is a negative 500%. But as you're going to see, this is going to get better over time. The reason this gets better over time is because, let's see here. So we're still at negative gross margins. It actually gets worse before it gets better. The cash flow in any month before taxes gets worse, and it gets worse largely because there's a big cost of goods sold in this period. There's also a step up in costs and sales and marketing. So I'm sorry, the whole difference here between December 25 and 6 is that there's a step up in sales and marketing team costs. That's discretionary. And if it were actually a step up of 25,000 that was going to push the burn rate up that much, it's really something that would need to be considered at the time. I'd say because the first 2 years do quite matter a lot, try to be as precise as you can with your hiring plans for the next 24 months. And make sure that, this is in fact something that would probably draw a question out. And it's like, why did your burn rate increase by what looks like 40% between 25 and 26 when you're already, bleeding money at this point? You need some really good business rationale to back that one up. But eventually, you see, it's still pretty negative So there's basically the takeaway that I can already see, right, is that this company is going to need a lot of financing up until at least 2 years from now. There's a big outflow here because of the hardware installation cost to service these sales that are being made. But all of a sudden we've got these little glimpses of profit, right? And suddenly all the profit from the gross margins is starting to become a lot more than the costs are, right? So we've got positive gross margins now, and all of these positive gross margins are going to paying down this operating expenses that we have to pay. And the net result becomes eventually that every month is going to have a positive return on all this investment, to the point where it actually becomes a pretty significant return on investment, because it's mostly because those software subscriptions are being done at such a high margin that they're actually paying for the rest of the business. And then that's getting access to that annuity payment from those software subscriptions is really the point of this business. And thinking forward just a little bit, they want to aggregate all the data that they're generating and start selling it to other NGOs and governments and other private institutions. So that would be another revenue stream that we haven't modeled here, but would be significant in terms of its gross margin potential and potential to create profit for the shareholders. So that's a bit about the strategy we can see with this. So I'm copying over this formula that brings in the monthly information. Okay, I'm just going to check this according to my other model here. It's about right. So negative cash flow before taxes for the first few years means we're actually not going to have a tax bill, because this would need, well, it's a small tax bill, whatever tax is on 1.4. less the costs incurred so far. So probably there'd still be no tax in 2029 for this company. So we're not actually going to model that right here. Now this will be where we stop for operations. But you can see that there's this inflection point, which is really interesting. And I'll show you the completed version of this once I'm done here. But you want to see that inflection point. And that's when people ask you, when's your break even? It's going to be somewhere in 27, 28, right? In between those 2 years. Usually you don't need to be more precise than that, because people respect that this is, kind of like a strong guess. But to say like a month, it's not 37 months from now. It's like nonsense, right? So cash flow from investing. Here's a company that's probably not going to do a whole lot of that. Let's see. Oh yeah, okay. So I'm just going to copy this over. So what I've got here is a bunch of zeros. But then in year 4, January 2028 starting, there's going to be these outflows. $4 million, and that's because Oyster Tech created a facility of their own in this year. So this is them making payments to the contractors who are now creating the facility for them. And then, of course, they're going to bring the equipment in later on down the road. So you'd have a whole capital plan and, big business case to be made to actually do this facility. And you'd have invoices or at least estimates from the project managers and such that you would use to then put this number in. I just know they need a facility. So I put those numbers in as something that's showing growth plans later on down the road. And, there's no reason you can't be more precise in years 4 and 5. It's just tough when it comes to sales. It's easier when it comes to the costs, right? Because if you know that you want a new facility, you also know that there's going to be a cost associated with that, right? And then the reason that we put investing so close to financing is that financing is what's going to make that facility happen, right? Because this business won't be generating enough margins at that point, a year 4 point, to be able to invest $4 million by itself, right? It's going to need outside help. So Oyster Tech's raising $2 million right now to $8 million pre-money valuation. So they're going to give up 20% of the company after the new money comes in. They got a big tech grant, a sustainable tech grant coming in for $500,000 in June 25. And then we're going to go over. Then they're going to do the Series A raise for it's about $7 million in 2027. And that's going to allow them also to, first off, to scale up in 2027 with that new sales team that we talked about, increasing the burn rate so much. Also, it's going to help them cover the facilities that are starting in 2028. Okay. And after that, you saw that the company becomes profitable in 29. So ideally, they wouldn't have to raise a whole bunch of external capital on top of that. Chances are they would, because if anything, we're definitely these models usually don't fail in the direction of, oh, we were way more profitable than we expected. Usually it's we were way less profitable because margins weren't as high as we thought, because we got squeezed on price or we got squeezed on cost of goods sold. So therefore, we didn't generate the margins we thought we were going to. Therefore, we didn't have as much to invest into keeping the lights on with all the overhead and all the salaries. And when that happened, it required us to then go out and raise more money, right? So in this case, I'm trying to factor in what's reasonable, a seed round for 2 million, Series A for 7, maybe a small Series A. But this isn't also the biggest opportunity, right? Like, I figure this market's only about $500 million. So OysterTech really needs to be the number one leader to make this a venture with the scale potential that a venture capitalist would be interested in. Yeah. And then again, you want to see these finances happen before any kind of big cash outlay in investing, right? It wouldn't make a whole lot of sense to have that after. You'd have this big gap in your cash balance. And that's almost it, folks. Last thing here, cash summary. We got to do one more thing, and that means, where are we starting at? So I assume they had 285,000 in the bank. What is the change? It's going to be the sum of cash in from financing, cash out for investing, cash in or out for operations. So they get this big they get this big injection right at the beginning. Okay, and I'm going to put this here. We can't just fill that over because it's not going to bring with it the closing balance. I need to do that. So opening cash, about 300,000, add in all this new financing plus the first burn rate, first monthly burn equals the ending cash. Bring that ending cash to the opening for the next month and keep applying it like that, and you roll it forward until you get to the end. Okay, and then this is kind of a little bit janky at the end here. This is going to be like that. That's going to be like that. I need to redo this. Bring that over. Bring that over. The last check you can do here to make sure that you've done all these calculations right is that this number here should equal that number there in bold, and they do. So that means I've made no keystroke mistakes, and actually everything is working as it should be. There's all kinds of ways to add more information to this, right? I mean, you can get into the cash burn metrics and different ratio analysis throughout, different analysis of how much cash you're going to need. I'm going to do that real quick right here too. So let me get rid of these grid lines. Terrible things. What was I doing? Right. So if I get rid of this round of financing, right? Say that it's not going to, 2 million is not going to come in, but we do have 300,000 in the bank. So how long is this going to last? Well, you can see it's cash balance is dwindling. We got some cash in because we made a sale or something like that, or a recovery. And then we got this grant. So, okay, cash balance is good again. There's a bit of contribution margin, gross margin being applied. And then it's not until March 26 where the cash dips negative, right? So this is how you can estimate your runway, as if you're pretty certain about that grant. Okay, leave it in there, right? Or maybe it's confirmed. You got it in writing, even better. Let's say that's in writing. So I'm actually going to leave that in because I'm very confident about that. I could say that for OysterTech to deliver on the strategy that they've set out for themselves and the remainder of the data room and their investment memo, their business plans, their scale-up plans, their go-to-market approach, their product roadmap, their hiring plans, if I didn't say that already. All these things then feed this information into the model. And if these plans are to actually happen, the financial implications are as such, right? And we can see that there's going to be kind of a tough cash situation for the first half of next year. It gets better with that grant, but then this business isn't going to sustain itself in much past March 26. So the runway is 14 months, give or take a few. Okay. And then we look at how deep this goes into the negative, right? So if we still assume that the Series A is going to happen in 27, which is after they start to, get a few customers, 25 to be exact in the plans, they still need to cover a maximum of $1.3 million until then. So that's exactly why I came back here and said, well, we need $2 million to do that, right? So now we're going to go over. The lowest we get is 714. That's enough margin for error, right? Like it's not going to be 714. It's going to be less in all likelihood. But hopefully that's enough where there doesn't need to be a mezzanine round or a C plus round or some kind of extension to get to that Series A. If it goes according to plan, this should be enough margin for error to make sure that the Series A happens in time. Right now, the Series A market's pretty tough out there. So, I mean, if we're talking reality, maybe I would think twice about that and think about another round of financing in between the seed and the Series A. But that's very much going to be a per business analysis that needs to be done. But this is just how I would think about actually coming up with the number. It's not going to be, your burn rate times anything. Like you just did all the work to see this happen over time. So why not see, okay, where's the biggest shortfall we got? It's 1.3 million. Okay, well, let's give ourselves enough cash to get over that. And that way, if an investor says, what are you going to do with the money? Do you need this much? That's your answer, right? It says, yeah, well, we do. We do need that much because that's what's going to finance these plans we just put before you. Plus, it's going to give us enough of a buffer that we can make sure that we get all the way to the next raise. And we're going to invest, say, 40% of this money in a GIC to make sure that it's doing something useful in the meantime, right? Because we don't need all $2 million in the first year. We maybe need the next 800,000 in the second year. So we're going to lock it away and earn some money on it until then. So that's that. You've seen it. You've seen it happen, come to life. We started here back in the good old days of very simple calculations, sales, cost of sales, gross margins, operating expenses, different categories of cash flow, and then ultimately your ending cash balance. So this is where I would now put a dashboard. I'm not going to do it here, but got all these tabs set up. Looks pretty good. I'm going to bring my completed model over, show you a couple things. So different model now. I'd have a couple metrics about burn rates. I would then bring all this information from over here. I would then bring it to the dashboard to really highlight the annual information. And what we do is create some charts. So you can see this increasing over time, this as in sales, what this means in terms of market penetration over time, what this means in terms of sales by type, so software versus hardware. You can see how software increases at such a higher rate than hardware does. So it's that much more useful to the company. It also happens at a much higher gross margin too. And I haven't visualized that, but you could just as easily. Cash flow from operations, this is what you would call a J curve, right? Where you see a dip down where the risk is high at the beginning. And then all of a sudden, there's going to be this inflection point in year 27 when the business figures it out and they start making profit on sales. So all this money here, this negative half, negative 1, negative 2, 1.2 million, someone needs to get you across that risk. And whoever it is, that chasm of risk, and whoever it is going to want a share of your company, right? So that's how you can visualize the amount of dilution about to happen to you. The closer you can get to this inflection point, the less you're going to have to dilute your company. And some companies just need more dilution to get to where they want to go because they're deeper tech, right? So maybe software, it even just starts barely negative and then it goes, positive right away. And that's why investors love those companies, right? I've visualized the customer count over time. Small farmers, there's way more, but ultimately the large and medium are actually driving sales a lot more, and just because they're a lot larger. Employees by function, different cost categories, use of funds, different cost categories. You can see CapEx was big here, about 4 million for that new facility. Net burn rates, considerable here when they're making bigger sales. The cash balance here, you can see how it just kind of dwindles over time. And then this is the big step up is going to be the Series A. And then it's still not going to be profitable until a point in time that this is truly your break even, right? So now all those margins from sales are paying to keep the lights on. And now you can actually reinvest some of this cash into like different V2s of the product, right? So what this is showing is that people got in for this bet on this monitoring technology in this market with these customers. You needed one more round to really get you there. But then you've built up enough productive capacity and you've tested enough assumptions, and the product is good, the customers are happy, and things are being sold profitably. Now, this thing's going to run its course, right? Hopefully it's going to continue to grow. You're going to keep investing resources. You might just open up a whole nother model and say, actually, we're going to change the business now to salmon. It's going to have a different product. It's going to have a different go-to-market. It's going to have a different geography to it. Like, it needs a fully separate model at that point. And then your business becomes something that's actually the sum of two different models, right? So it's almost like a consolidation now. You've got different divisions, different profit centers, and they'd be consolidated into one. So that's not going to happen for a while, but that's what the next step of this modeling exercise would be. And that's kind of what you're looking at this point. You'd have this consolidated entity. I think I can stop there. Long video. If you stuck with it, geez, I hope it was valuable for you. This is pretty much, it's still a lot of what I've learned over the years doing this work. Like I say, probably close to 100 financial models now. So everything in here should have a purpose. I've tried to make sure it does. I'll have more videos about some of the details, in particular about how to get to sales and how to start it out, because there is a lot of, like I say, low fidelity mocking up of the structure of the sales model that needs to happen before you can even get to this point. So that's probably where you're going to get tripped up when you start out on this. But, stick with it, get through sales. Once you're through sales, that's the majority of the hard thinking that needs to go into this. And yeah, on the top side here, I pull out the key assumptions as a communication tool, because you're not going to want to do a meeting with investors and go into all those individual calculations. You want to avoid that like the plague. What you want to do is come to like a key assumption tab where you can say, here's what's really driving this model. Here's the thinking that goes into it. And here's why it matters, right? And so Series A, we expect to do 5 million, 6.66 million, raise at 20 million pre-money. At that time, why do we think that? We expect to have 25 customers at an average annual contract value of 50,000 or more for over $1 million run rate. So that would be sufficient for a Series A. In some cases, right? Like, again, there's a lot of other factors here, but in terms of a forecast and the revenue model, it would be sufficient. Okay, well, thanks everyone. Yeah, like I say, more videos coming. And if there's any video that you really want to see more information about, send me an email, drop me a note in the comments or something. I'd be happy to take a look at that. Thanks a lot.